A banker and a thief walk into a bar. The banker says to the thief, "You're doing it all wrong. There isn't any money in what you do." Smugly, the thief says, "Want to bet? I have a job this Friday, and I'll show you just how much money I can make." The banker laughs and says, "You're on." The thief, figuring he was just going to rob the banker's vault, figured he could teach this guy a lesson while enriching himself. Friday comes, and the thief busts into the bank and demands the teller open the vault. The teller, without hesitation, opens it, and to the thief's dismay, there was only $10 in the vault. The next week, the banker and the thief meet up at the bar again. The banker asks how the job went, and the thief says, "I only made $10 stinking dollars." The banker says, "I'm glad you learned your lesson. It's a lot easier to rob people when you own the bank." Now, obviously, people, this is a joke. I don't think banks rob people. However, I do think there is some truth in that joke. And that truth is this: banks do not hold as much cash as people think. And why would they? Banks earn money on the spread. They take in deposits, paying interest to the deposit holders, maybe, and then make loans, charging borrowers more interest than they pay on the deposits. And if there's any money left over, they make investments. But what types of investments do banks hold? In this episode of GAAP Chats, we'll discuss the types of investments held by banks using Silicon Valley Bank as an example, and how these investments are accounted for under U.S. GAAP. Welcome to GAAP Chats, the podcast dedicated to all things accounting, brought to you by GAAP Dynamics. I'm your host, Mike Walworth, and with me, as always, is my faithful partner, Chris Brundrett. We hope you'll join us on our journey today as we share our passion for accounting and help change the way you train.
Welcome back, Mike. How was your trip?
Well, it was a little cold and wet. As you know, I went to Northern California, and let's just say we had a little bit of precipitation.
Yeah, they're getting really hammered, but at least their reservoirs have filled up. So what are we talking about today?
Well, it's all in the news, so I thought we'd talk about banks.
Didn't you listen to last week's podcast that Bob and I recorded? We already talked about banks.
Yeah, I listened. I did listen to it. And by the way, thank you. Thank Bob for stepping in for me. And Chris, thanks for taking over the hosting duties. Of course, I listened to it. But, you guys talked about Silicon Valley Bank, and you talked a little bit about the investments there, if I remember correctly. But then you kind of jumped into Credit Suisse, its material weakness. And, you spent a lot of time on that material weakness, and it was related to the statement of cash flows, which I know, of course, is one of your favorite topics. And so what I wanted to do this week is kind of dig a bit deeper into the investments held by Silicon Valley Bank and discuss how they're accounted for under U.S. GAAP.
All right, I'll allow it.
All right.
And really, the only thing we talked about last week, as you know, Mike, was just sort of, the state of the banking world, right? And the mention of Silicon Valley Bank, at least as it comes to investments, was just, a little bit about what type of investments they were holding. So I think it'll be good to dig into this a little bit deeper.
Yeah, because, one of the things that when you first think that a bank's failing, and let's go talk about this a bit, like back in 2008, right, the financial crisis, and, Bear Stearns and all that stuff, it was risky investments, wasn't it? It was
right.
It was those mortgage-backed securities. It was all the subprime lending stuff that kind of was the downfall of all those banks. And so I think the average layperson probably saw, these Silicon Valley Bank. What was the other one that you mentioned?
Silvergate Capital, which was crypto, in the crypto world. And
yeah, and there's First Republic now.
Yeah,
and stuff.
I didn't dig into their balance sheet, but you look at Silicon Valley Bank, of course, as you mentioned, the first reaction would be, well, they must have had risky investments, right? And but they didn't, right?
Yeah.
They had. We'll talk about the interest rate, effects here that certainly contributed to some of the issues. But this is really like safe stuff, right?
Yeah, well, let's look into it. That's what I did.
Yeah.
I said I really want, because I think the average layperson probably assumed that they were making risky bets, and in reality they weren't. So let's get into it a bit. So as of December 31st, 2022, so I'm looking at Silicon Valley Bank's 10K. Okay, they had total assets of $211.8 billion, of which $120.1 billion related to investment securities on a consolidated basis. Now, when I looked at that, that's a lot of investments. It means that they weren't able to make loans, but in listening to kind of what happened, and you guys touched on it, during the pandemic, all these technology companies were flush with cash, and so they basically made all these deposits right into the bank, and they just couldn't loan it out fast enough, probably. And so they were stuck with, what is that? That's over half of their assets and investments.
And that's exactly what happened, right? That's exactly what happened. And as we mentioned on the podcast, what started the issue and the run on the bank was, here we are, the tech industry is experiencing some volatility right now, and they were seeing deposit holders starting to pull money out, quite a bit of money. Now, it wasn't enough to cause their downfall. That was the run on the bank. But that was sort of the start, was people were pulling money out.
Yeah, so of this $120 billion of investments on the balance sheet, on the face of the balance sheet, it was broken out as follows. You had $26.1 billion of available for sale securities. You had $91.3 billion of held to maturity securities. And then you had a little bit, $2.7 billion of non-marketable and other equity securities.
Okay. So, so you mentioned available for sale, held to maturity, and then non-marketable and other equity securities. So just for our listeners' benefit, what's the difference between available for sale and held to maturity securities?
Okay, that is a fantastic question, but I wanted to kind of let's make one thing perfectly clear right now. Both of those categories, Chris, under ASC topic 320, both of those categories are debt securities. So you can't have equities and available for sale or held to maturity. So we're talking all debt securities, or, in layman terms, bond investments. And so we'll get into the specific bonds held by SVB in a moment. But if you look at it, when you add those two categories together, basically Silicon Valley Bank held $117.4 billion of bond investments. That's about 98% of all the investments held and 55% of total assets. And so therefore, I think in this episode, because I started to go down and we're going to talk about all of it, right? That's what I did last night when, kind of planning it out. And I was like, holy moly, we got too much. So let's just break it down if we can we'll talk about these debt securities, okay? But to answer your question, let's do held to maturity first, okay? These are investments that the bank has the positive intent and ability to hold until maturity. And according to ASC 320, these securities are reported on the balance sheet at amortized cost.
So they're not held at fair value.
No, definitely not. And that's the advantage. That's why probably banks want to use this. Basically, they're saying, I'm using this category. I don't care about short-term fluctuations in price. And guess what? My shareholders shouldn't either, because I'm holding it to maturity. And of course, if you hold a bond to maturity, you're going to get paid the interest of the face amount plus the principal at the end, assuming there's no credit problem. But, the SEC and the FASB said, hey, man, it's important to know how underwater or overwater these bonds are. And so they even held to maturity securities, we have to disclose fair value.
Okay, so held to maturity, obviously, until maturity. So, what happens if we were to sell the securities before maturity? And this happened with SVB, is they were trying to fund the deposit holders taking cash out.
Yeah. Well, generally speaking, you're not allowed to sell, right? There are a few exceptions related to some, I'll call it allowable sales outlined in 320, ASC 320. But if you sell and it's not one of those allowable exceptions, bad things happen, very bad things.
Right. Well, let's clarify. You said you're not allowed to sell. You can do whatever you want.
Yeah. Okay. Sell. Yeah. They're not going to handcuff you. You're right.
Right. This isn't. But there's the accounting rules. You're right. There's repercussions, obviously, if you do sell before maturity. Or else why have the category held to maturity? It wouldn't make any sense. So, What are the bad things that happen if you were to sell?
Yeah. So if you sell it and it's not one of those allowable things, first thing that happens is all that category is dead to you, right? Mm-hmm. All other held to maturity securities at that time need to be transferred either to the trading or available for sale securities categories, both of which are reported on the balance sheet at fair value, meaning that you're going to have to recognize any unrealized losses in the held to maturity portfolio immediately, either in the income statement for trading securities or within accumulated other comprehensive income for available for sales. But more on that in a moment. There's another bad thing that happens, and that is this. That category is tainted, meaning that the bank cannot classify any future debt securities as held to maturity for a period of 2 years.
All right, so you mentioned some sales are permitted. Can you expand on that a little bit?
Yeah, sure. There are specific times when an entity can sell a held-to-maturity security and not taint their portfolio.
All right. Can you quit saying that word? I mean, have you looked at Urban Dictionary recently?
Well, it's funny because I don't know if it wasn't you, it was Bob, I think, and we were teaching an accounting firm, and we kept talking about this, and the class kept snickering, and finally Bob stopped them and like, what the hell's going on, guys? And they said, check out Urban Dictionary. And of course, Bob and I were like, oh, mortified. But actually, if you can believe it, and I made sure about this last night, Chris, it is actually in ASC 320. So it's used by the FASB, it's used by the SEC. Anyways, if we can quit being high school kids for a moment. ASC 3, no, I can't stop. Anyways, ASC 320 does provide some examples that wouldn't, mess up. I won't use it again. That wouldn't mess up that portfolio. Things like one of the things is like an evidence of a significant deterioration of the issuer's creditworthiness.
All right. I mean, that makes sense. It wouldn't be fair if an issuer is really experiencing problems that the accounting rules would require them to hold these investments and lose all their money.
Yeah, and there's some other ones too, like if all of a sudden there's a change in the tax deductibility of interest, or so there's some change in the IRS rules or taxability of these things. There's some change if there's changes in regulatory, if there's been a significant business combination and you're trying to keep your percentages of what's available for sale or held to maturity at a certain level. So there's those types of things in there. But another example would be a change in statutory or regulatory requirements significantly modifying either what constitutes a permissible investment or the maximum level of investments in certain kinds of securities.
Okay. All right. So, I mean, the first two you mentioned, that totally makes sense, right? Yeah. I mean, tax, like an example would be, the investment was a non-taxable, right? And then, it becomes taxable. I mean, that would be one. And regulatory you mentioned, right? I mean, people that aren't in the banking world, there's a lot of rules out there for banks.
There's capital charges for certain types of securities. And so if the Fed changed that capital charge, then you're like, well, shit, I can't hold this thing anymore. Then I have to sell it. And that wouldn't be something that would screw up your portfolio.
Right. And that's great. Okay. So, but now hypothetically, sort of steering us back to SVB, right? I mean, what if the bank was forced to sell such securities because there was a run on the bank? I mean, they had to sell the securities to fund the deposit holders.
Well, that's a great question. And actually it's what happened at SVB.
Right.
I actually looked into it and I found the answer within the guidance. And this doesn't happen all the time, but actually ASC 320-10-25-8. That's a lot of dashes there, but
a lot of dashes.
It basically says, so 320-10-25-8 says if a regulator directs a particular institution rather than all institutions supervised by that regulator to sell or transfer held to maturity securities, for example, to increase liquid assets, those sales or transfers are not consistent with the permissible sale exception that we just discussed.
That's interesting. So the regulator is pointing at, so it's not a change for everybody, like you were mentioning before, a change in some capital ratio or whatever. But this is the regulators pointing at a specific institution and saying, you need to sell. Right, that is not a permitted exception.
No,
interesting.
That is interesting. So I thought they were dead to rights. I thought all that $91 billion or whatever they had held to maturity was immediately going to come out.
Right.
And because we'll talk about the unrealized losses in that portfolio in a minute, but that would have been even worse for that bank. But there is another catch-all exception within the guidance that says if the sale meets the following four conditions, and all four of these conditions need to be met, then a sale would not taint the portfolio. These conditions are, number one, the event is isolated. Number two, the event is non-recurring. Number three, the event is unusual for the reporting entity. And number four, the event could not have been reasonably anticipated.
All right. I mean, thinking through those four as you're going down, I would say a run on the bank would qualify.
Yeah, and the FASB agrees with you, Chris. A few paragraphs after that one I just read, I won't read out the other reference. It does state that other than extremely remote disaster scenarios, such as a run on a bank or an insurance entity, very few events would meet all four of those conditions.
PCAOB inspections and the associated inspection reports can bring stress to audit engagement teams everywhere. If you want to improve your team's audit quality, and reduce the number of potential deficiencies in your reports, GAAP Dynamics can help. Join us for our upcoming webinar, Improving Audit Quality, on Tuesday, April 25th, 2023 at 11 a.m. Eastern Time. It's free to register, and you'll hear directly from PCAOB inspectors about risk assessment, internal controls, supervision, and review. And the best part, you can receive up to 1.5 hours of CPE credit. Register now at gapdynamics.com. That's GAP with 2 A's, dynamics.com, or simply click the link in the description. Hope to see you there.
Okay, so to clarify for the audience here, it's a little sort of backwards how they're saying it, right? They're just saying overall, very few events are going to meet those 4 criteria, and they're indicating to us those are real strict. Like you gotta really, really look into it. But they use as an example of one that would meet the 4 criteria, something like a run on a bank. That's really interesting. Those words were in there.
Yeah, I copied that. I read it exactly like it was. Yeah. So yeah, I mean, so to summarize, SVB was required most likely. I mean, I don't know exactly, but I think they were required to sell some of those held to maturity securities to meet some capital demands, or to meet the run on the bank, or the depositors' demands rather. And according to what we just went through, that would not taint their portfolio of the remaining $91 billion of held to maturity securities. Okay,
interesting, right? Because remember, that's a big deal from an accounting perspective, right? You lose the held to maturity classification, you're now available for sale or trading, and that means fair value, right? And we'll talk a little bit more about that. So, all right, so back to it. What types of held to maturity securities does or did SVB hold?
Well, 75% of that category, so about $68 billion, is actually agency-issued residential mortgage-backed securities. Another 16% of that category, or $14.5 billion, is agency-issued commercial mortgage-backed securities.
Okay, so pretty safe stuff, as we were talking about earlier, right? I mean, given what you just mentioned, these are securities that are issued by entities like Fannie or Freddie, which, as we saw during the 2008 crisis, is more or less backed by the U.S. government. And remember, these are government-sponsored entities, they call them. Theoretically, the government doesn't have to back them, but they sure did during the financial crisis, right? I mean, they are, for lack of a better term, too big to fail. I mean, that would cause a major issue in the financial system.
Yeah, and it's interesting. We're not talking about it now, but CECL, ASC 326, and the current expected credit loss allowance, there is an exception in that rule that says if the risk of loss is remote, or not even remote, if it's nil, if it's zero, right? If there's no risk of loss, then you don't have to set up an allowance on it. And one of the things they give in the guidance is like U.S. Treasuries. Well, some banks that we work with and some accounting firms have basically made a judgment that says, hey, this agency stuff is just like U.S. Treasuries. So I think you're right, Chris. I think you're exactly right. This is pretty safe stuff. And then the remaining 9% of the category. So we're already up to, 68, 14, 82 billion of the 91. That 9% of the category comprises just munis and corporate bonds.
You just violated one of the rules that we have when we teach
don't do math,
right? When we teach training, right? I learned that early on. Even if you're great at doing math in your head, for some reason, when you're up in front of the classroom or even doing a podcast like this, it's just like it all goes out the window. So good job on that. That was good. Yeah. Let's move on to debt securities classified as available for sale.
Okay, but before we do, I want to talk about that third category, which is the trading category, okay?
Right.
These securities, so trading securities, these are securities that the bank acquires with the intent of selling it within hours or days. Although, the guidance does not preclude entities from using this category if they want to. Basically, trading securities, they are reported at fair value, with changes of fair value immediately reported in profit or loss. SVB did not have any debt securities classified as trading, and most banks actually don't. So that category really isn't used.
Okay. All right. And you mentioned just, I find it interesting, the guidance, they'd say what it's supposed to be, right? Selling, intent to sell within hours or days, but it doesn't preclude an entity from using the category if they want to. They don't have to prove that, right, at all.
Yeah.
And the reason for that is the FASB is more than happy if you want to account for something at fair value through the P&L.
Right, exactly.
They're pretty cool with that overall.
Yeah. So available for sale, Chris. How do we account for available for sale, or what should be an available for sale?
Okay, so available for sale securities. I mean, it's kind of the middle category, if you will. Again, these are investments in debt securities. Okay, because all of these categories only apply to debt securities, right? Equity securities now have their own guidance. Okay, so. These are debt securities that are not classified as trading or held to maturity. So, they're kind of in the middle, right? There's no real specific rules about that. They just don't qualify for either one of those two categories. Now, such investments are reported at fair value on the balance sheet, but the changes in fair value are recorded in other comprehensive income net of tax. So, available for sale securities have unrealized gains or losses. They haven't gone through the P&L yet, right? They're sitting in OCI net of tax. And so, OCI again is other comprehensive income. This is a component of equity, right,
okay,
Mike?
So let me ask you, so basically all of these debt securities, whether they're trading, available for sale, or held to maturity, might have unrealized losses. For the trading securities, those at fair value through the P&L, those unrealized losses or gains are immediately reported in the P&L, right?
Right.
We talked about held to maturity. They have unrealized losses too, but I said that they were only just disclosed because they're held to maturity is held at amortized cost. But you're saying these available for sale, they also have unrealized gains and losses, but those actually show up in this OCI, this separate component of equity.
Right. Unless
okay.
there is an impairment loss that's required to be reported in profit or loss.
Okay, so I did note, Chris, that SVB, in their available for sale portfolio, they had unrealized losses of $2.5 billion, and they appear to still be included in OCI. Can you briefly explain how and when these impairment rules would kick in, or when that might be coming out?
Yeah, absolutely. So just to sort of summarize where we are. So available for sale securities, fair value, but the changes in fair value are generally recorded in other comprehensive income, right? Which is a component of equity, unless there is an impairment. And then that impairment is recorded through the P&L. So we measure impairment of available for sale securities on a security by security basis. If a debt security's fair value, which is its carrying value, is less than the amortized cost, it has an unrealized loss, and that security is considered impaired. However, as you noted with SVB, that unrealized loss can still reside within OCI. Only in certain circumstances is that impairment loss recycled, we call it, out of OCI and recorded as an impairment loss in the income statement.
Such as when? When would that happen?
First of all, if the entity intends to sell the security, or it's more likely than not that they will be required to sell the security before recovery of the amortized cost basis, then the full amount of the impairment loss is immediately recognized in the income statement. If that's not the case, meaning they don't intend to sell the security, or it's not more likely than not that they'll be required to sell before recovery of the amortized cost basis, then we need to determine if any of that unrealized loss relates to a credit loss. If a credit loss exists, right, we're looking at the credit of the issuer here, right? If the credit loss exists, it must be recorded in the income statement with an offset to the allowance for credit losses, right? Because credit losses, yikes, right? I mean, that those are considered more serious, and that's why they get recognized.
So let's just kind of time out for a second here. Those credit losses, you can have changes in fair value due to changes in credit rating, or you can have credit, quote unquote, losses. I think we're talking about here the losses, right? These are actual,
right.
When I look at expected cash flows, the cash flows are going to be less, and I'm actually not going to recover as much as I thought, the amortized cost basis. And so I need to book those immediately, like you said, through this allowance for credit losses.
That's right.
Okay. Now, if it shows up as an allowance for credit loss, I'm trying to remember my accounting theory class, that's a contra asset account because it's an estimate of the future losses or whatever. But doesn't that mean if things get better, that allowance can kind of get reversed?
It certainly will. And that was one of the big changes that occurred when ASC 326, which is the current guidance that we're talking about here, came about, right? So we used to losses, once they were recorded in the P&L, that was it. They never got reversed. But now you do and must reverse if things get better.
The credit piece of it, the
Right.
credit loss piece. So what about the other portion of the unrealized loss that doesn't relate to credit losses?
That just remains in OCI.
Okay, so if I go back to SVB, we had that $2.5 billion of unrealized losses on its available for sale debt securities. And I said, and I looked, and it says they're still sitting in OCI. That means SVB must have determined that, number one, it didn't intend to sell those securities. Number two, it was not, more likely than not, that they would be required to sell the securities prior to recovery of that amortized cost basis. And three, none of that $2.5 billion must have related to, of that unrealized loss must have related to credit losses.
That's correct. And I'm assuming that most of the unrealized losses were interest rate related. And that makes sense because remember, we talked about the reason why they have such a large investment portfolio is they were purchasing investments when they had a lot of cash coming in during the pandemic. Well, remember, interest rates were super low back then, right? Historic lows. But now we're in a rising interest rate environment. And what was it, yesterday or the day before? I can't remember anymore. I'm losing track of my days here. Thank goodness it's Friday. But the Fed raised rates again, right?
So 25 basis points.
Yeah. So we're in a rising interest rate environment. And so, I would assume overall SVB is holding investments that are of a high credit quality, and they are, right? We talked about it.
That was the held to maturity. So this is a different category, right? So let's just, but it's the same stuff. In fact, so it looks like in the available for sale category, much like the held to maturity category, it's all pretty safe stuff. So they had $16 billion in U.S. Treasuries. So I mean, if you believe in the U.S. government, it's the safest stuff out there, right? That was 62% of the entire category. And the rest of the category, just like held to maturity, was agency-issued residential and commercial-backed securities. They did have a little over $1 billion in foreign government debt.
Okay, so not a whole lot of credit losses going on. I mean, U.S. Treasuries, are still safe investments, right? So this is likely interest rate related.
Yeah, definitely. And I just realized, Chris, if I go back to the held to maturity now, SVB had $15.2 billion of unrealized losses related to its held to maturity portfolio, which you remember, since held to maturity is amortized cost, those unrealized losses were only disclosed. I had to go back to the footnotes to find it. So you want to talk about, held to maturity, debt securities, and impairment?
Oh, yeah, we didn't talk about that. Okay, so held to maturity debt securities are part of the current expected credit loss, CECL. You mentioned CECL earlier. That need to be estimated in accordance with ASC Topic 326, our new guidance on credit losses. So, we definitely, unfortunately, I'll say, and definitely, we don't have enough time to go through that one, right? That's a big deal. How do you, measure current expected credit losses? But that held to maturity securities fall under that guidance. We'll have to save that topic for another episode.
Yeah, so ASC, I agree. So 326, CECL, the CECL model, current expected credit losses, that's going to be your amortized cost type investments. So all your loans, your held to maturity debt securities, that sort of gets all wrapped up in that CECL allowance. And I definitely think that would be a good topic for another day.
Even accounts receivable, right?
Yeah.
For if there's any non-bankers out there. So it's a broad one. We definitely ought to talk about it sometime.
All right, so we'll put it on the hopper list to talk about CECL, and maybe I can come up with some good stuff on how the current environment, this would be something we could ask that client I was talking about earlier, how the current environment has impacted the CECL allowance of these banks. So one more thing real quick before you sign off. We do have 2 courses dealing with accounting for investments under ASC Topic 320, that is your debt securities, that's what we just went through, and ASC Topic 321, that is investments in equity securities, which we did not get through, available on our Revolution, that's our online learning platform. We've packaged them together in a 2-course collection, priced at a significant discount. I'll put that link to this collection in the notes to the podcast. Chris, why don't you take us out?
I will. And I'll also just add on, of course, we have courses on ASC Topic 326 and CECL, but we'll give you the reference to that when we talk a little bit more about that in a future episode. So
awesome.
That's all for this episode of GAAP Chats, your source for all things accounting. Notes and resources from today's episode are linked in the description. And as always, you can find us online at gapdynamics.com and at gapdynamics across social media. It's never too late to become a gapologist. Head over to our website, subscribe to our blog so that you are the first to know what's new with GAAP Dynamics.